Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be back.
I want to kind of set the scene for everyone listening. It's February 2026. President Trump is back in the White House. D.C. is, well, it's as loud as ever. But for the people who actually move money traders, bankers, the real show isn't at the White House. It's just down the street at the Federal Reserve.
That is absolutely right. All eyes are on the central bank.
And there's one name that's dominating the whole conversation. Warsh. The headlines are all screaming about a new era, a regime change at the Fed.
Right.
Now, I know for a lot of people, the Fed just sounds like this, dusty place where economists argue about decimal points.
Sure. It can feel very abstract.
But we have combed through a huge stack of research from Reuters, Moody's Analytics, the ECB over in Frankfurt, even market data from Asia. And this is not just some bureaucratic shuffle. This is a shift that, well, it impacts the cash in your wallet.
And the rate on your credit card.
Exactly. And the price of goods on the shelves. Our mission today is really to decode that whole reaction. We want to take this complex Fed speak and just translate it into plain English.
It's about looking at why a personnel change in D.C. makes a banker in Tokyo start to sweat.
And why the price of gold can just plummet overnight.
And to do that, you really have to look past the political drama, the personalities, and get into the actual mechanics, the plumbing of the financial world, so to speak.
So let's jump right in. Segment 1, the American reaction. The news breaks about Warsh. What was the immediate verdict from the markets?
Well, if you look at the data, from the very moment the news hit the wires, the reaction was fascinating. It was this mix of what analysts are calling qualified relief.
Relief. That's surprising. I mean, given the political climate, I would have expected something more like panic or, uncertainty.
Well, we have to compare it to the alternative, right?
Right.
The market has started to price in what some were calling a burn it down scenario.
What does that mean?
There was a genuine fear among big institutional investors that the White House might push for a candidate who wanted to completely dismantle the Fed's traditional structure.
Someone who wanted to, abolish the central bank?
Or return to a strict gold standard, like tomorrow. So compared to those really radical fears, Warsh is seen as orthodox.
So it's kind of like, imagine you're on a plane, and you're worried the airline's going to hire a pilot who wants to fly the plane upside down just to see what happens.
Right, just for fun.
But instead, they hire a guy who's known for flying fast, maybe taking some aggressive turns, but he definitely knows how to fly the plane. He knows the instrument panel.
That is a perfect analogy. And because the market realized that upside-down pilot wasn't coming, we saw an immediate shift. The data we reviewed from Reuters shows two things happened at once. The U.S. dollar rallied, it got a lot stronger, and the price of gold and silver dropped sharply.
Okay, let's unpack that. Usually people buy gold when they're scared, right? It's the apocalypse insurance.
Exactly. So when you see gold drop that fast, it's the market effectively canceling its insurance policy. They're removing what's called a catastrophe premium. The message was, okay, the system probably isn't going to collapse next week.
But you called it qualified relief. That implies there's still a but.
The but is independence. This is the core conflict of 2026. While the market thinks Warsh is competent, they're very worried about his leash. We have analysis here from Mark Zandi at Moody's Analytics, and he calls the choice rational, but he flags a massive risk.
Which is?
Can the Fed chair actually say no to the president?
Because we know President Trump wants lower interest rates. He's been very vocal about it. If the Fed chair is just a rubber stamp for the White House, I mean, does the Fed even really exist anymore?
That's the fear. If the market starts to believe the Fed is just a political arm of the White House, the value of the dollar could, eventually crash. But there is a check on this power, and it comes from inside the building.
You're talking about that report regarding Raphael Bostic?
Yes. Bostic is a Fed insider, a regional president, and he gave a warning that I think is crucial for everyone to understand. He reminded everyone that the Fed chair is not a CEO. He is not a dictator.
So he can't just walk into the room and order everyone to cut rates?
No,
Oh.
not at all. He's the chair of a committee, the FOMC. There are 12 people voting on interest rates. And Bostic's point is that a new chair needs the trust and support of the other 11 people in that room to get anything done.
That's a really important distinction. It's like a jury, right? You have a jury foreman, he reads the verdict, but he's just one vote. If he walks in and says not guilty, but the other 11 all say guilty.
The foreman loses.
Yeah.
Exactly. And the other 11 at the Fed are generally very data-driven, very cautious people. So even if a new chair wants to move fast, He has to convince the jury.
Which suggests this new era might be a lot slower to happen than the politicians expect.
It might. So you have a personality clash, chair versus committee. But let's talk about the actual money. Segment 2, the policy tug-of-war. We hear a lot about interest rates, but our research suggests the real battle is over the balance sheet.
The balance sheet. I would argue this is a most important story of 2026, even if it's not on the front page.
I'd agree.
Okay, so for anyone who isn't a bond trader, let's just simplify this. What is the balance sheet?
Think of it as a massive reservoir of water. Over the last, 15 years, during the 2008 crash, the COVID pandemic, the Fed pumped trillions of dollars of water into the banking system to keep it from drying up.
By buying bonds.
By buying bonds.
Yeah.
Now the Fed is sitting on this massive lake of assets.
And the goal of the new leadership is to drain the lake. Get back to normal.
That's the idea. They want to sell those bonds or let them mature. That takes money out of the system. It's called quantitative tightening. The theory is if you drain the excess water, you reduce inflation and get back to a real market.
Sounds reasonable. So what's the problem?
The plumbing. According to the Reuters analysis we looked at, the banking system has become, addicted to that water level. Banks use those reserves to settle payments with each other every single night. If you drain the reservoir too fast,
The water level drops below the intake pipes.
and if the pipes start sucking in air, the engine blows up. We actually saw a preview of this back in 2019. The Fed tried shrinking the balance sheet, and suddenly the overnight lending market it froze. Interest rates spiked like crazy.
Oh, wow. So there's a hard floor on how much they can actually cut.
A massive constraint. The White House wants to shrink the government's footprint. The new chair wants to shrink the balance sheet. But the banking system itself is saying, whoa, if you pull that plug, we crash.
And this has to complicate the interest rate picture, too. President Trump is calling for rapid rate cuts. He wants to hit the gas pedal.
He wants to boost the economy, sure.
Mm.
But the Fed, that jury we talked about, they're looking at the dashboard.
And the dashboard says, caution.
It does. If you look at the futures market, this is where people bet real money on where rates will be. Investors have not priced in aggressive cuts for 2026.
Wait, really? Even with all the political pressure?
Yes. The market is betting on the brakes, not the gas. They believe that inflation risks and these balance sheet issues will force the Fed to keep rates higher than the president wants.
So it's like a car ride where the passenger is screaming, go faster, but the driver is staring at a check engine light and is just refusing to speed up.
That's a perfect summary of the U.S. domestic situation. But this car isn't driving in a vacuum. It's on a global highway. And that brings us to segment 3, the view from Europe.
The wake of the ship. I love this analogy in the notes. Why does a banker in Frankfurt care so much about an argument in Washington?
Because the U.S. economy is just too big to ignore. It's the cruise ship. We have analysis here from Philip Lane. He's the chief economist at the European Central Bank. He warns that even if Europe is trying to do its own thing, these U.S. policy tussles, as he calls them, are a major risk factor.
We mentioned the dollar surged. A strong dollar means a weak euro. Doesn't Europe usually like a weak currency? Makes German cars cheaper for us to buy.
In a normal world, yes. But 2026 isn't a normal world. Europe is still fighting to keep inflation down. And the problem is that commodities, oil, copper, all of it, are priced in dollars.
Ah, I see. So if the dollar gets more expensive, so does oil for Europe.
Exactly. A strong dollar literally imports inflation into Europe. It forces the cost of living up for everyone in Berlin, Paris, and Rome. So the ECB is trapped.
How so?
They might want to cut interest rates to help their own sluggish economy, but if they cut rates while the U.S. stays high, the euro just collapses even further. They're handcuffed to the Fed.
That's like a gravitational pull.
It really is. There's a concept called term premiums. Our data shows that if U.S. long-term rates go up, maybe because the Fed is shrinking, that balance sheet European rates tend to get pulled up too. They just can't escape the gravity of the U.S. bond market.
So if I'm in Europe, I'm watching Washington and just praying for boring, steady policy. I don't want that cruise ship making any sharp turns because the wake could capsize my little boat.
That's the view from Frankfurt. But if Europe is worried about the wake, Asia is worried about a tsunami. Let's move to segment 4, the Asian perspective.
We looked at data from Tokyo and Beijing. It seems even more tense over there. Let's start with Japan.
Japan is walking the tightest line of anyone. The Bank of Japan is trying, after decades, to normalize their economy, trying to raise interest rates just a tiny, tiny bit to get off of zero and stop runaway inflation. But they have the yen to worry about.
And the yen is incredibly sensitive to the U.S. dollar.
Incredibly. When the Warsh news broke and the dollar jumped, the yen just got hammered. It lost value instantly.
Okay, so let's use an analogy here. The Bank of Japan is a tightrope walker. They're way up in the air. On one side, they have to fight inflation. On the other, they have to stop their currency from crashing. They're trying to balance.
And a strong U.S. dollar is like a sudden, violent gust of wind hitting them while they're on that wire. If the dollar gets too strong, the yen falls off a cliff, and that would force Japan to intervene, maybe panic hike interest rates, which could cause a recession.
So Washington sneezes and Tokyo catches pneumonia.
Precisely. But then you have China. And this is even more complex because of the trade dynamics and, the sheer size of their economy.
We saw a report from the South China Morning Post. They sounded pretty skeptical about this whole new era.
Oh, they are. Chinese economists don't really buy the stability narrative. They see a U.S. political system that's very volatile. But the real problem is domestic. We've got the January manufacturing data from Reuters and Nomura.
And the numbers weren't good.
No, they dropped. China's factory activity is slowing down. They need to stimulate their economy in 2026. They need to cut rates, punt money in, get growth back.
Okay, so why don't they just do that?
Because of something called the impossible trinity. It's a fundamental rule in economics. You can't have a fixed exchange rate, free movement of capital, and an independent monetary policy all at the same time. You can only pick two.
Okay, let's try the juggler analogy for this one.
Perfect. Imagine China's central bank is a juggler. Ball number one is growth. They need to keep the economy moving.
Okay.
Ball number two is the yuan. They want a stable currency, not a crashing one.
Yeah.
And ball number three is capital. They want to keep money inside China, not have it flying out to other countries.
And a strong U.S. dollar messes up the juggling act.
It makes it nearly impossible. If the U.S. has high interest rates and a strong dollar, money wants to leave China and go to America to earn that higher return. That's capital flight.
So if China cuts rates to help growth, ball one, then the money leaves even faster and the yuan, ball two, crashes.
Exactly. U.S. policy effectively puts a ceiling on what China can do to save its own economy. They're boxed in. Stimulate too much, your currency collapses. Defend the currency, your economy stalls.
It's just amazing how connected all of this is. A decision made on Constitution Avenue in D.C. puts a factory owner in Guangdong in a terrible bind.
That is the ripple effect.
So let's bring this all home. Segment 5. The investor playbook.
Yeah?
I'm listening to this. I've got a 401k. Maybe I'm saving for a house. I'm not a hedge fund manager. What does this actually mean for me?
I think the most important takeaway is this. Stop obsessing over the person and start looking at the regime.
What do you mean by that?
We waste so much energy debating Warsh versus Powell, But the data tells us the structure matters more. And we can pull 3 clear lessons from this analysis.
Okay, lesson 1.
Credibility is king. Remember how gold dropped and the dollar rose before a single policy actually changed? That tells you that trust is a real asset. The market was pricing in a risk of the U.S. basically destroying its own currency. That risk, for now, has been lowered.
So the vibe shift is a real thing. It actually changes the starting line for every investment.
It absolutely does. Okay, lesson 2. Watch the plumbing, not just the headlines. This is crucial for anyone looking to buy a home. You might see a headline that says, Fed chair wants lower rates. But if the Fed is also shrinking that balance sheet reservoir we talked about,
then mortgage rates might not actually go down.
Correct, because mortgage rates are tied to long-term bonds, and the balance sheet directly affects the supply of those bonds. Do not assume a friendly Fed chair automatically means cheap mortgages. The plumbing dictates the rate.
That's a huge insight. You could see a rate cut on paper, but still be paying 7% on a mortgage. And the third lesson.
Know your vulnerabilities. If you hold international stocks, you have to understand the mechanics we just discussed. A strong dollar environment acts as a brake on emerging markets. It squeezes China. It puts pressure on European earnings.
So if you see the dollar ripping higher on the news, automatically, that your international portfolio is facing a headwind.
Correct. The strategy is to respect the discount rate. The U.S. dollar and U.S. rates are the gravity of the global financial system. When that gravity gets stronger, everything else feels heavier. It doesn't matter how charismatic the Fed chair is.
I love that visualization. Gravity doesn't care about politics.
It really doesn't. And that leads me to one final thought, so something that wasn't explicitly in the reports, but it's the question that's just lingering underneath all of them.
What's that?
We're asking if Warsh can be independent. But in 2026, with the national debt this high, with political polarization this extreme, and with the global economy so fragile, can any central banker truly be independent anymore?
That is the multi-trillion-dollar question, isn't it?
Is the market reacting to Warsh the man, Or is it simply pricing in a temporary truce between the White House and the Fed? Because if that truce breaks, if the political pressure for rate cuts overrides the economic data, then all these models we just talked about, they go right out the window.
A truce. That's a sobering thought. We might just be enjoying a ceasefire before the real conflict over the value of money really begins.
It's certainly a possibility we need to be prepared for.
Well, on that note, we hope this cleared up some of the fog around the Fed for you. It's complex, but understanding the plumbing puts you miles ahead of the crowd just reading the headlines.
Absolutely. Always look at the data, not the drama.
Don't forget to subscribe and hit that like button. We'll see you on the next Deep Dive.